Many people want their money to grow. They work hard, earn income, and save part of it. But money sitting in a bank account grows slowly. Inflation also reduces purchasing power over time. Investing gives money the chance to grow faster and build wealth over many years. Investing means putting money into assets with the goal of earning a return. A return comes from price growth, income payments, or both. Common investment assets include stocks, bonds, funds, real estate, and businesses. Each asset carries a different level of risk and potential reward. Because of this, investors follow different strategies depending on their goals. The first strategy is long-term investing. This approach focuses on patience. Investors buy assets and hold them for many years, sometimes even decades. During short periods, the market moves up and down. News, politics, and economic changes push prices higher or lower. But when you look at long periods of time, many markets show steady growth. Long-term investors ignore short-term noise. They focus on the overall direction of the economy and businesses. Large companies expand, create new products, and increase profits over time. When profits grow, the value of those companies often grows as well. Long-term investing also benefits from compound growth. When investments grow, the gains produce new gains in the future. Another strategy is growth investing. Growth investors search for companies expanding quickly. These companies often operate in industries such as technology, renewable energy, artificial intelligence, or biotechnology. They reinvest most of their profits into expanding the business. Because these companies grow fast, investors expect the stock price to increase strongly in the future. For example, a small technology company might create a popular product and expand around the world. Early investors benefit when the company becomes much larger. Growth investing offers high potential returns, but it also carries higher risk. If the company fails to grow as expected, the stock price drops quickly. Growth investors study financial reports, industry trends, and company leadership to estimate future success. The next strategy is value investing. Value investors search for companies selling for less than their real worth. Markets do not always price companies perfectly. Sometimes negative news causes investors to panic and sell their shares. This pushes the stock price below the company's true value. Value investors analyze financial statements, earnings, debt levels, and business performance. If the company still performs well, they buy the stock at a lower price. Their goal is to wait until the market recognizes the company's real value again. One well-known value investor is Warren Buffett. He focuses on strong businesses with solid fundamentals and buys them when the price looks attractive. Value investing requires patience because it sometimes takes years for the price to recover. Another popular approach is dividend investing. Some companies share part of their profits with shareholders. These payments are called dividends. Investors receive regular cash payments while still owning the stock. Many large and stable companies pay dividends. Examples include companies in industries such as energy, consumer goods, and telecommunications. Dividend investors often focus on companies with a long history of steady payments. This strategy creates income while the investment continues to grow. Some investors reinvest their dividends into more shares. Over time, this increases the number of shares they own and accelerates compound growth. Another popular approach is index investing. Instead of picking individual stocks, investors buy funds that track an entire market index. A market index represents a group of companies in a specific market. For example, some indexes track the largest companies in a country. When you invest in an index fund, you buy small pieces of many companies at once. This spreads your money across different businesses and industries. Diversification reduces the risk of losing money from a single company performing poorly. Index funds also have lower management costs compared to actively managed funds. Because of this, many investors prefer them as a simple and efficient way to invest. Another important strategy is dollar cost averaging. This method focuses on consistency rather than timing. Instead of investing a large amount at once, investors invest smaller amounts at regular intervals. For example, an investor might invest a fixed amount every month. Sometimes the market price is high, sometimes it is low. Over time, the average purchase price balances out. This method reduces the pressure of trying to predict market movements. Even professional investors struggle to predict short-term price changes. Dollar-cost averaging builds discipline and creates a habit of regular investing. Some investors focus on short-term strategies. One of these is day trading. Day traders buy and sell assets within the same day. They attempt to profit from small price movements in stocks, currencies, or cryptocurrencies. Day trading requires quick decisions, technical analysis, and constant attention to the market. Traders study price charts, trading volume, and market patterns to identify opportunities. While day trading attracts many beginners, it carries significant risk. Markets move quickly and losses accumulate fast. Professional traders often spend years developing their skills. Another major investment strategy involves real estate. Real estate investing focuses on properties such as houses, apartments, and commercial buildings. Investors earn money through rental income or through the property increasing in value. For example, an investor buys a house and rents it to tenants. The monthly rent produces regular income. Over time, the property value might also increase. If the investor sells the property later, they gain profit from the higher price. Real estate also offers diversification because property values do not always move in the same direction as stock markets. However, real estate requires larger starting capital and maintenance costs. Risk management plays a major role in investing. Every investment carries some level of uncertainty. Prices rise and fall due to economic changes, company performance, and global events. Diversification helps reduce risk. This means spreading investments across different assets such as stocks, bonds, real estate, and funds. It also means investing in different industries and regions. When one investment performs poorly, others might perform better. This balance helps stabilize the overall portfolio. Another key concept is time horizon. Investors choose strategies based on how long they plan to invest. Someone saving for retirement in 30 years uses a different strategy than someone saving for a purchase in 2 years. Longer time horizons allow investors to accept more short-term volatility because they have time to recover from market downturns. Shorter time horizons usually require safer investments with lower risk. Successful investing also requires discipline. Markets experience periods of fear and excitement. During market declines, many investors panic and sell their investments. During market booms, others buy assets at extremely high prices. A disciplined investor follows a plan and avoids emotional decisions. They focus on long-term goals instead of reacting to daily market changes. For beginners, simple strategies often work best. Long-term investing, index funds, and regular contributions create a strong foundation. These methods require less time and reduce the risk of major mistakes. Over time, investors gain more experience and understand how markets behave. They adjust their strategy based on knowledge, financial goals, and risk tolerance. Investing is not about getting rich quickly. It focuses on steady progress over many years. Small investments made consistently grow into large amounts through compound growth. The most important steps remain simple. Start early, invest regularly, diversify your investments, stay patient during market fluctuations. Time, discipline, and consistency turn investing into a powerful tool for building long-term wealth.